Is the danger zone over? The danger zone for Bitcoin usually denotes a period before the halving where we tend to see historical pre-halving retraces. We've seen a danger zone manifest into a pre-halving retrace in 2020, also in this cycle, and also in 2016, where Bitcoin performed a 29% retrace up to 40% retrace as a result of entering this danger zone. So the question is the danger zone over for Bitcoin in this cycle? Let's talk about that in today's video. Subscribe to the channel for more videos like this in the future. Like this video if you enjoy content like this going forward, and let's dive right into it. So talking about these historical pullbacks, in 2020 when Bitcoin entered the danger zone, this is where we saw a 19% pre-halving retrace, and this was Bitcoin entering the danger zone 14 days before the halving. In this cycle, we actually entered the danger zone approximately 30 days before the halving, and that prompted the first 18% pullback, which occurred essentially here. If we just zoom in, this is where that 18% pullback occurred in March, and then once again 17% in April, and it's a pullback we're currently seeing once again. So we can actually rationalize this pullback and this one as one of the same, essentially as one pullback, because we are in a range. So let's say if Bitcoin were to lose this range and drop even lower, that would essentially mean that this is the top and the bottom is wherever Bitcoin goes next. So in total, one larger retrace. But because we're seeing Bitcoin hold this support right now, this looks like two retraces. So that is consolidation, and retracement is part of consolidation in this channel. But the main thing to note here is that danger zones tend to be 28 days, roughly speaking, wide. And historically, in 2020, it was 14 days before the halving where we saw a pre-halving retrace. In this cycle, it was 30 days before the halving where we saw a pre-halving retrace. And in 2016, it was 28 days before the halving where we saw a pre-halving retrace. So historically, this danger zone is 30 days wide. And the fact that we've seen a pullback occur every single time in that 28-day window is just a testament to the historical cyclicality that we see constantly repeating within the cycles and price moves relative to a key reference point in Bitcoin's price, and that's the halving event, a fundamental shift in the blockchain protocol for Bitcoin. So this danger zone has effectively caused what it was supposed to cause. This danger zone is typically where we see pullbacks and pre-halving retraces, so this danger zone has essentially come to fruition, but we have to talk about whether or not this danger zone is going to slightly extend into the future, and that's a compelling idea, because if we look at 2020, for instance, the danger zone prompted that pre-halving retrace, but we never really went lower. So essentially, the bottom of that pre-halving retrace occurred before the halving, and most of these pre-halving retraces, if you look by these pre-halving retraces, a small portion of them occur before the halving, but the majority of these pullbacks and consolidation periods occur after the halving. So when it comes to 2020, the danger zone essentially was over the moment we bottomed before the halving, and then we just entered the reaccumulation phase. But in 2016, we had a slightly different scenario where 28 days before the halving, we saw this pre-halving retrace kickstart. We saw a 29% retrace take place, or even up to 40% if you take into account this downside wick. So pre-halving, we already saw that initial downside wick here, that crash, right? But after the halving, we saw additional downside. So in effect, this danger zone didn't just end before the halving, it extended a few more weeks after the halving. So if we're thinking about a pre-halving danger zone, which is 28 days wide, a 28-day window, and Bitcoin in this cycle pulled back 30 days roughly before the halving, so a little bit earlier than that window, if we think about the pre-halving danger zone, we need to also potentially factor in or at least consider a potential danger zone after the halving. So a second danger zone. So whether that's going to be a extension of this danger zone or just a new second danger zone, which is 3 weeks wide. So essentially 3 weeks, a 3-week window, 21 days after the halving. So if the halving was last week, then technically we have a 3-week window of 21-day extra window, maybe even less than that right now because it's the 25th of April. So we definitely have 21 days minus 6. So just over 2 weeks left for this danger zone, post-halving danger zone, based on historical tendencies in 2016, for this post-halving danger zone to come to full fruition. The pre-halving danger zone has come to fruition. We've seen pre-halving retraces occur, and it's about these next 2 weeks, these 2 pivotal weeks. Can we continue to hold on at the range low here? And if we do within the next 2 weeks, then that gives us a fair degree of confidence that maybe, just maybe, this reaccumulation range low is going to continue to hold. But even looking at 2016, that first pre-halving retrace, that crash, this downside wicking, gave us a good idea of where the bottom of that range low is going to be in the future, and we tapped that level in the post-halving period, but still overextended below there. So judging by that, we've seen loads of downside wicks into this range low in the pre-halving period, marking out that potential range low. So could we see history repeat where we still revisit this in the post-halving period in the coming while, but slightly overextend with a downside wick in the future, repeating 2016? It's a possibility worth noting. But the other thing to note really is the retracement depths, because 29% occurred in 2016, 40% with the downside wick occurred in 2016, 19% occurred in 2020. So we've pretty much satisfied the historical tendency of dropping close to 20%, which is what we had in 2020. But even looking at these ranges throughout this current cycle, we've seen many 20% pullbacks throughout the cycle. So a 20% retrace occurring right now, or at least a close to 20% retrace occurring now, is very much in line not just with the retracements we've seen over the course of the cycle within these respective previous reaccumulation ranges, but also very much in line with the historical pullback that we saw in the pre-halving period in 2020. 2016 is a dark horse in some respect because it was a deeper retrace. So you could argue that this was a less mature market, more fluctuations, and you can definitely see that in the downside and upside wicks throughout the cycle. But at the same time, we still see this sort of volatility around key moments, whether it's upside wicks or even downside wicks. So these wicks still can occur, but not to the extent, not to the volatile extent that we saw in 2016. So that's a caveat worth mentioning. If we were to see a bit more downside, it would probably be in a capitulation phase in the form of some sort of extreme volatility below this potential range low here, and that would be probably one of those V-shaped bottoms, very similar to what we saw right over here in 2016. And having said that, that's about it for today's video. Thanks so much for watching. Subscribe to the channel for more videos like this in the future. Like this video if you enjoy content like this going forward. I'm Rekt Capital, and I'll speak to you in the next one. Check out the top right hand corner video for more. Speak soon.